want to stick with the markets now and bring in Anik Sen, who is Global Head of Equities at PineBridge Investments. Anik, thank you for being with us. I want to start with cryptocurrencies. You just heard Jared go through it there. We have ARK Invest, Cathie Wood, coming out and saying, yesterday's capitulation, as she called it, was just a sign that cryptocurrencies are on sale right now. I'm curious if you're in that space at all, and did you see yesterday's market activity as an opportunity to get in?
Alexis, I'm sorry to disappoint you, but we are not really experts on crypto. I kind of treat this as, part of the retail phenomena that we see, and the volatility that I think one of your co-presenters showed you is really not part of our investment thesis. So, there you have it. I'm sorry not to be able to expand more on crypto, apart from, as an expression of the liquidity and the volatility that you see as a result of retail activity.
All right, so then let's look a little bit more broadly at the markets. I want to talk about the Fed minutes. We discussed them a little bit yesterday. Now, they show that they've been discussing, that they need to see substantial progress on some of their inflation goals. Now, people we've been talking to, it seems like there's two completely different camps here, at least when it comes to the inflation and the Fed and the moves that the Fed is going to be making. Some saying that the Fed is right, that some of these moves in inflation are indeed transitory, while others, and I believe it was Octavio Morenzi just yesterday who said this to us, who said, I think the Fed is looking at completely different data or charts that are not available to the rest of us right now. And it seems like the Fed is going to have to make some moves, perhaps sooner than they have been indicating or that many hope for. Wondering which camp you're in right now, if you think inflation concerns remain one of the bigger risks to equities right now.
I'm of the camp that inflation concerns are not such a big risk to equities right now, because a lot of the price escalations that you've seen more recently are a function of bottlenecks. That's the first thing. Those bottlenecks are transitory. You've seen that in the data. You've seen that in the detail of the CPI numbers that came out. And as the reopening starts to become more widespread, those bottlenecks will fade. There are certain commodities, particularly copper, which is obviously a long-term secular demand story. But I think there are a lot of other areas where I think there is a transitory bottleneck that is in the process of easing already. You have to look at some of the trade data, some of the port data as well, to know that bottleneck is starting to clear. The other thing that I would say is, prior to the pandemic, we had very low levels of unemployment, and we had tons of QE, and none of that really kind of resulted in the sort of inflation that we are kind of fearing today. One of the things that I point to is the trapped liquidity that exists as a result of QE. We had tons of trapped liquidity before the pandemic. And if anything, if you look at the loans deposit ratio in the banking system, there is still that phenomena of trapped liquidity. So I don't think QE in and of itself creates inflation or inflationary tendencies. It does create asset price reflation, but that's a completely different thing. So when I compare the situation post-pandemic to the pre-pandemic situation, I don't see this as developing into an inflationary concern just as of yet. I know that there are tons of fiscal stimuli that are still trickling through from the various government actions, not just in the United States, but also in Europe and the rest of the world. But those phenomena will pan out, I think, over a longer time frame. And Kristin, you're absolutely right about the Fed. I think they have adopted a much bigger and wider dashboard, particularly on unemployment, than we have seen the Fed look at in the past. So I completely take them at their word that their inflationary targeting of this average phenomena will result in a longer cycle, lower risk premium. And this is definitely not the time to be getting negative on equities. There are certain phenomena that I think we should be aware of, which is that the markets have run pretty hard already. We do need those earnings upgrades. And as we came through the results season, we are seeing those earnings upgrades come through, but the quantum of upgrades is starting to plateau out. So as conclusion, I would say that this is much more of a selective market. And as you mentioned earlier on, stocks are reacting pretty violently to disappointments and less positively, where earnings beats are coming through. So expectations are high. And so I would say the selectivity is really the key.
So if selectivity is the key and you don't believe that inflation is really going to be much of a problem, I'm curious where you're concentrating your efforts right now, because a lot of folks have been hedging against higher inflation later in the year with things like commodities. You mentioned copper. We've been seeing gold start to get back in favor. And a lot of people have been treating the crypto space as a way to hedge against inflation. Are you at all implementing a hedge? And if not, where are you looking for opportunity?
Yeah, the way we manage our portfolios is to hedge out the risks that we don't really kind of analyze and take a position on. So, we tend to be broadly neutral now on things like the semiconductor space. We tend to be neutral on commodities. We also tend to be neutral right now on currencies and rates because those are factors which in our investment process are top-down factors. We are really looking at the bottom-up drivers of companies and the bottom-up drivers of management actions, particularly in a wide range of industries, but a wide range of industries where a change management process is really kind of delivering, either in terms of adoption of technologies or in terms of using technologies to become more competitive. So I would say there's a whole range of opportunities out there in every industry. But we are hedging ourselves extremely carefully to style rotation because this is going to be a much more volatile market going forward, particularly as we start to see those earnings revisions beginning to plateau. So it's not a time right now, I think, to be chasing market beta. It's not a time, I think, to be chasing style as well, because those are going to be rotating pretty frequently as we really kind of try and understand the position of the Fed, how the language of the Fed is going to be moving from here till the year end.
All right. Anik Sen, Global Head of Equities at PineBridge Investments. Thanks so much for joining us today.